We get a lot of questions about diversification and specifically diversifying maybe outside of the country that you live in. If you're a US based investor, maybe that means diversifying to Europe, Asia, South America, you name it. While we don't advocate diversifying just for the sake of diversification, we do agree that there are so many great businesses out there outside of chip stocks, outside of the United States, if you're a United States investor. And one of those has grown to be a top portfolio holding for us, and that's Sea Limited.
And it got that way because we placed a bet early on. We bought the dip in 2022. And then other than that, we just left it alone.
Welcome back to Chip Stock Investor. Let's talk about Sea Limited.
This first chart on Sea Limited brought to you by the sponsor of today's video, Fiscal.ai. We'll talk more about this slide momentarily, but the takeaway here, check out that revenue growth up and to the right. That's all good stuff. But look at the early stages of operating leverage taking place for C there in orange. The flip from negative GAAP operating income to positive operating income, especially over the course of the last year and a half. If you're trying to figure out what is driving a stock higher, you need to understand what's happening with the business itself. And Fiscal.ai is the platform you need to help you understand what's doing that and visualize it with nice looking charts like this one.
You can get 15% off any paid plan, even their new enterprise plan, which has a ton of new features. Check it out, 15% off, fiscal.ai/CSI. Let's start with our hierarchy of the economy chart for C. It's in the products and services category. They offer a lot of different things, really. They're kind of a mega conglomerate in a way. They offer the Garena entertainment platform that develops some of their own games, and then they also license some other games to that platform. They have the game Free Fire, which is apparently wildly popular. I'm not familiar with it, but it's
I've never played it either.
Yeah. We'll show you some select images here from it in just a moment.
Yeah, I think I mentioned before, like Casey is still working through the Horizon series on the PS5. So
yeah, it takes me forever to finish a game. Like one game could take years, to be completely honest. Yeah.
She's not the authority on video games.
No, I'm not.
Neither am I.
They also do some esports in that Garena platform. C also has Shopee. That is the marketplace. There's a wallet in that app. Digital banking is part of Monee. Very cute. Shopee and Monee for C. And yeah, they have a bunch of stuff.
It's a huge market.
Yeah.
Huge addressable market at the top of the hierarchy. So we've actually only ever done one official update on C. I don't know why that is. I think there's just not been a lot of interest in this, but in the last year especially, there's been a lot of interest because the stock price has gone up, which I think is important to point out because a year ago when we did the only official update on C that we've ever done on CSI Live, we mentioned the fact that the market at the time was pricing in expectations for a rate cut. And so C stock was kind of going up just solely based on that. And we mentioned maybe we'd trim the position to maintain our cash. We never did that. Hopefully you didn't either because, this is why you want to let your winners keep winning. This is the company's operating revenues, which continue to obviously go up and to the right. And that operating income in orange, it's been a pretty stunning turnaround, really. And we'll delve into this in more detail here in a bit. But management got the memo from the bear market a few years ago. Hey, you guys need to be operating at this kind of scale. You need to be operating profitably. And so that's exactly what they've gone out and done. So GAAP operating income up more than double so far this year through the first half of 2025, over and above more than double what they did at the end of 2024. So it's been a great run for the company. And the other reason we wanted to talk about this now, obviously the stock is up, and so there's interest in C stock. But we have the commentary about the take private deal of Electronic Arts, which is a big deal and could have big repercussions for the broader gaming industry because EA is so big. C is kind of I guess you could say our biggest video game stock now. If you exclude AppLovin, which is a way for companies to monetize their mobile video games, but let's call C a video game business. Hopefully that becomes apparent why we call it that.
Here's their revenue breakdowns. And this may be confusing why we're talking about it as a video game company at first glance, because they make a lot of actual revenue coming from their e-commerce and some from digital financial services there on the left and middle. But Let's focus on digital entertainment bookings. And what exactly is a digital entertainment booking before we continue?
There's a lot of different ways a booking can be logged for a video game company. Most commonly these days for a company like C, a lot of their games are free to play, but there's in-app purchases. And a player can deposit funds within Garena, and then that becomes a booking because the money hasn't been spent yet, but there's like a commitment that the money will be spent. If a customer has deposited funds because they want to buy some sort of power up or alter the look of their character within the game, you deposit funds in there, and then that becomes a booking, and eventually that gets realized as revenue when the player spends the wallet, the money deposited in the wallet.
I'm just going to throw up a screenshot of Free Fire here. Like maybe you want to change that bandana color on that bird, right?
Yeah, why not?
And this game is one of the most popular in the world,
Mhm.
right? One of the largest mobile games in the entire world. So a lot of people are playing this game and spending money, making bookings. And this is why we're talking about this being primarily driven by this segment of the business.
Yeah, and it's important because this was one of the headwinds for C in recent years was Garena. That's the platform overall. Free Fire, the game, which makes up most of the revenue for Garena, had kind of stalled out. There were multiple things that had happened to Free Fire, besides the fact that it's almost a decade old now. But that's starting to change. Bookings growth has returned, and they just raised their full year guidance for Garena as a result. They expect bookings to grow more than 30% in 2025 over and above 2024. This is great news. Active users also back on the rise again. There on the far right, you can see almost 665 million quarterly active users in Q2 2025. And as a percentage of that total user base, 9.3% of users are paying users, meaning they purchased something within the game or within Garena overall in Q2. And so this is what's driving the bookings growth. This is all good news if you are a C shareholder. All right. At this point, maybe you still have it at the back of your mind. Most of the revenue is coming from e-commerce. Shopee. And in fact, even Monee, the digital financial services part of the business, digital entertainment is in third place in revenue. Why do we still call this primarily at this point a video game company?
Take a look at that EBITDA number. Most of the earnings is actually coming from this digital entertainment. You can see e-com 227, 228 million, digital financial services 255 million, and digital entertainment 368 million. So this is much more a media platform business.
Yeah, 44% of adjusted EBITDA, earnings before interest, tax, depreciation, and amortization still coming from Garena and Free Fire. So when you see that segment return to growth, like it has for C as of late, this is fantastic because it's really, for years now, it's been Garena and Free Fire paying for the expansion of Shopee and Monee and expansion there, because up until just the last year or two, Shopee and Monee have not been contributing to the profit profile at all. So very much still a video game company if you view it through the lens of what's paying the bills. Garena Free Fire is where it's at. Let's break down the profitability and the balance sheet a little bit more. So this is helpful. At the top, focus here on the group. The group overall, that's the bottom table. So for the entire consolidated business, GAAP operating income is that first line. In Q2 2025, $488 million generated, up from just 83 million a year ago. This is one of the primary drivers of the stock price in the last year. It's been an epic run. Catching businesses like this that scale off of little to no profitability can be a fantastic time to buy a position. So C's been great. The adjustments to get to EBITDA there, they back out deferred revenue and related costs. So that would be related to bookings, for example, as well as within Monee. There's some backouts within that because of the loan book that they're growing. Depreciation, amortization, that's non-cash item because the money's already been spent. Assets have already been purchased, so you back out depreciation. And then finally, stock-based compensation, which in spite of the continued growth of C overall, they've actually lowered their stock-based compensation year over year to 162 million. So that's also good in helping with the scale up of this business from no profits to a pretty robustly profitable e-com for it. And then, of course, we have the balance sheet, which is the thing of beauty.
There's plenty of net cash and investments, 11.5 billion, and only 1.5 in debt. So definitely what you want to see in a fast-growing business.
Yeah, definitely helps extend the runway. And this is especially important in a market like Southeast Asia, as well as Latin America. C has maintained its business and making some good headway in Brazil, in Mexico against Mercado Libre, but primarily Southeast Asia. They're based in Singapore, operations heavily concentrated in like Indonesia, Malaysia, Thailand. But these are fast developing markets, so-called emerging markets. And a company like this, kind of like Mercado Libre has done for Latin America, can do basically a great deal of work to migrate over the economy from the old ways of doing business to online and digital. And so you want to have a strong balance sheet in a company like this when they're not just growing, but actually literally changing the way people do business every day. You want to see this balance sheet gives the company a full tank of gas to continue driving that growth and that economic change. Back to profitability, related to profitability, this is how we arrive at earnings per share and PE ratios.
Earnings per share at 195 in the last 12 months. The PE ratio, it's very difficult to see, 91 to 92x. And on a forward-looking basis, 36 times. And this is definitely reflective of the fast scale up of GAAP profitability on that operating income slide we showed you a little bit earlier.
Yeah, and the write-up a year ago, we talked about free cash flow as well, because at that point there was very little GAAP profitability. But now that there is GAAP profitability for this particular company, let's just use plain old GAAP earnings per share. That's why we have just the PE ratio here. So obviously on a forward-looking basis, it's still not a cheap stock. But remember, PE ratios on their own don't tell you much. So let's take this one step further. Let's take the current trailing 12-month earnings per share and run a very, very simple reverse DCF to see what's currently baked into the stock price. And because the earnings growth is so high right now, let's just do a 1-year earnings growth outlook. We picked 80% for the next 12 months as an estimate off of the $1.95 baseline that we have for the last year, and then an 8% terminal growth rate thereafter. Standard 10% discount rate gets us to the fair value of what the stock price was trading at the time we ran this, $175, give or take. The stock price goes up and down every day. This is a sample scenario that we think is somewhere at the midpoint of what the market has baked into the stock for growth expectations. This still looks pretty reasonable to us anyways. You can argue with that 8% terminal growth rate shouldn't be that high, but we've had this conversation many times. This GDP growth rate is not what the market uses to discount a stock, especially not this one. But if you're just looking at high growth for just another year, and then things rapidly slowing down, cooling off, starting in second half 2026, 2027, is a pretty cheap stock if you think there's any chance at all that C grows faster than that 8% terminal growth rate into 2027 and beyond. That's what we're looking at here. Yeah, this is one of the reasons why it may be tempting to trim stocks, because the valuation looks expensive. But if a company has good momentum, they're profitable, which is indicative of them doing good, productive work, and they've reached a certain scale that they can self-sustain their business without outside funding, without outside capital from debt or issuing new stock, equity, just leave it alone. More often than not, leave the stock alone. And at this point, it looks pretty good. If you're looking for an integrated e-com with digital payments, digital banking, of course, the video game industry kind of starting to get consolidated even more, you might want to take a look at C.
We're talking about C as well as many other companies that are not exactly chip stocks over on Semiconductor Insider. Make sure you check it out, chipstockinvestor.com.